Okay, so, you know, just when you might have been bracing yourself for, well, more trade fireworks between the U.S. and China, something pretty unexpected happened this past week. It sent this wave of enthusiasm through the global markets. We're talking about a really significant shift, something you could almost feel in that U.S.-China trade dynamic.
It is fascinating, isn't it? How quickly the mood can just change in the markets. So, in this deep dive, we really want to explore the specific policy moves that led to this relief, and importantly, what it actually means for the bigger economic picture globally.
Right, so the plan is to cut through the noise. We've got a detailed report here, and we want to give you a clear idea of what went down, why it's a big deal, and also what questions are still kind of hanging out there. The goal is you walk away feeling really informed, understanding the strategy behind this without getting bogged down.
Exactly. Let's get into it.
So what really kicked this all off, the thing that got the markets cheering, was a move by President Trump on Sunday, August 11th, 2025. He signed an executive order. And the main takeaway, capping the current U.S.-China tariff ceiling at 30%. Now, 30% might not sound like, zero tariffs, but the reaction suggests it was huge. What's the real story with that 30% cap, especially compared to the 145% that's being talked about?
Yeah, that 145% threat was looming large. So the significance of the 30% cap, well, it's pretty profound when you see it against that backdrop. Essentially, it tells businesses, okay, this is the ceiling for now. It removes that extreme, frankly, terrifying uncertainty of a potential 145% hike. Think about planning long-term investment or your supply chains. That kind of uncertainty is just paralyzing.
Absolutely, just kills any planning.
Right. So suddenly, companies have a bit more clarity. And then, very quickly, almost like a reciprocal gesture, China announced it would halt its own retaliatory tariffs for the next 90 days.
Okay, 90 days, so pause.
A pause. And it's not just, being nice. It suggests there's a mutual strategic interest here in maybe cooling things down a bit, creating some space.
And that immediate benefit, you could really feel it, right? Especially thinking about imports for, say, the Christmas season. That timing seems critical. Bringing relief just then? That must have been huge for businesses ordering stock.
Yeah.
Maybe for consumers worried about prices. What was the direct impact there beyond just the market numbers?
Well, the market reaction itself tells a big part of that story. It was almost instant and just overwhelmingly positive. It really underscores how much that built-up tension, that uncertainty was weighing everything down. Businesses, investors, they need some level of certainty. And that 145% threat, it was the exact opposite. So just taking that extreme possibility off the table, even with the current 30% tariffs still in place, it was like a massive pressure release.
And we saw that pressure release ripple out globally, didn't we? Japan's Nikkei 225 surged, hit record levels, I think.
Record levels, yeah. And strong rallies elsewhere, too. Australia, China's own Shanghai Composite.
Europe as well. Various European indexes saw gains, absolutely. Even oil prices, Brent and WTI, they saw modest bumps, clear increases.
It's pretty amazing when you think about it. A policy decision between two countries having such a widespread, almost synchronized positive effect everywhere. What does that tell us?
Well, connecting it to the bigger picture, it just highlights how much global economic stability really hinges on these moves between, the two giants. The market's response isn't just about the numbers on a screen. It's a powerful signal. It shows how psychology, how perceived stability can sometimes outweigh even, well, pretty high existing tariffs.
Because that extreme set was gone.
Exactly. That 145% number was casting such a long shadow. Removing it brought this immediate, palpable sigh of relief across global supply chains. It was much more impactful than just tweaking a percentage point here or there might suggest. Investors had been sort of holding their breath. This let them exhale. So, okay, on the surface, this sounds like really good news all around. And we're hearing economists, market specialists viewing it positively. You mentioned major banks like UBS, Deutsche Bank. They see it as a good sign. But you have to ask, right? Does this actually solve the deeper problems? Or is it more like kicking the can down the road? Is it real strategic depth here, or just a temporary truce?
That's a very fair question. And honestly, there's probably merit to both views. The optimism comes from thinking, okay, maybe this de-escalation, this stepping back from the brink, maybe it opens the door for better negotiations, better deals down the line. It creates a less hostile atmosphere for talks, perhaps.
Right, a better environment.
But then you hit the crucial point. What's still